Hello and welcome back to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today either on 94.1 FM WNBU or Cable TV 10 in New Bern. And we've got a great show for you today. Right before the break, we were talking about hedge funds, and this kind of relates to a larger matter of chasing hot performance. The biggest mistake that investors make, both individual as well as advisors, is they chase the hot performance. They say, oh, this fund manager, he's got a 5-year track record. We're going to put all our money with him, or this fund is this, or that fund is that, and this guy. And at our firm, we promote that global diversification, broadly diversified. We're never going to beat every single asset class every year, but what we prefer to do is construct portfolios that do well year in, year out, never going to lose a lot of money, and continually move forward on a consistent basis. And so if last year, the hot sector is U.S. stocks, we're not going to beat the best sector. What we are going to do is we're going to stay well ahead of the losing sectors, keep people's money safe, keep the portfolios moving forward. And that's the biggest mistake we see, is investors saying, oh, last year this was the best sector, so let's put all our money in there, or this was the best manager, let's go put all our money over here. Institutional world is awful about it. I sit on a number of boards and they look at, well, who are we going to hire? Who are we going to put our money with? And they look at these charts after charts after charts of 1 week performance, 1 month performance, 2 month performance, 1 year performance, 3 year performance, 5 year performance. And they never ask, hey, was the same guy in charge of the fund that whole time? Well, no, he wasn't. Well, then that data is meaningless. In fact, you see disclosures all over the place. Past performance does not equal future performance, but people ignore that. They don't ask, well, how much does this cost? Or who's running this fund? And what are their processes? What are their procedures? What's their philosophy? It's all about, this, what's the performance? And what people don't realize is that mathematically, 99.9% of the funds, managers, and things like that out there promoting their performance, statistically, those numbers are meaningless. They don't have a long enough track record. And so I'll kind of get off on that. But this is a perfect example. We'll talk about that some more in another show. But this is a perfect example. I talked on the show a couple months ago about John Paulson in the book The Greatest Trade Ever, where he bet against the housing market and made, like $10 billion in 1 year. It's called The Greatest Trade Ever. I mean, he bet against housing for several years. And a lot of his competitors, or people that felt the way he did, they ran out of money and they went out of business. And I was talking about the hundreds of millions of dollars that he had to have to even be able to bet against the housing market, and how it's really impossible for an individual investor, or frankly most institutions, to do what he did. But he did. He went out and he made $5 billion or $10 billion, and I think he made $5 billion the next year, some just crazy number. And so then he started a hedge fund, and people started flooding money to him. And this is the point that I want to make, is that his flagship fund so far this year, the headlines here in the Wall Street Journal, is down about 15% for the year through July, as compared to the 2% decline in the S&P 500 and the hedge fund index of 0.4 loss. And so some of his other funds, his leveraged version was down 22% through July. Anyway, my point in this is that just because a manager had a great year doesn't mean that you should flood your money and that he's got the hot hand. In fact, he said he admitted to a series of investment mistakes, and is frankly not doing that well anymore. And so the point is just, he may be a good guy, his fund may take off, but the point is just to rely on past performance when making your investment decisions is really a loser's game. The same thing with another one here, Greenlight Capital, David Einhorn. He's another famous hedge fund manager. His fund is down a lot. Once again, another hot hand that people started flooding money towards. is having a tough year. In fact, there was an article on thestreet.com about hedge fund managers who typically charge 20% of the profits of the client are doing extremely poorly this year. The whole hedge fund industry is very misunderstood. There's nothing wrong with hedge funds in themselves as long as people understand what they're getting into. Frankly, the fees to me are too much. It used to be what they call 2 and 20, a 2% management fee plus 20% of the profits. And in a low return environment, it's almost impossible for these managers to overcome this hurdle. And so we just caution you out there if you're looking at these hedge funds. They look very slick. They tout performance records. The hedge fund industry is very unregulated. It's a little bit, it's a lot less regulated than the investment advisory industry, and so you really have to be cautious. A lot of the comparison databases, when a company goes out of business, they just eliminate their record from the database, and so what happens is you have a survivor bias, and the people that are left look like they have really good track records compared to the index. So once again, just caution you to be careful when picking your investments, whether they be mutual funds or some advisor or a hedge fund based on past performance. It just mathematically, most of the information is statistically useless. We'd rather you examine the process and procedures of the manager to make sure they're going to look out for your funds. So we're coming up on another break. When we come back, we'll talk a little bit more when we return after a few short messages.